Today, we're going to explore one of the most commonly used metrics in the stock market analysis, the price to earnings ratio, or PE ratio. The PE ratio is like playing Russian roulette with stocks. A high PE is the loaded chamber, potentially lethal, where you're hoping it's blank, but the risk of financial mess is very fucking real. Breaking down the PE ratio components is like conducting an autopsy on a company's financial health. Just as a coroner dissects a body to reveal hidden causes of death, investors dissect the price per share and earnings per share to uncover underlying financial ailments. It's a grim examination that reveals the true state of affairs. Refers to the current market price per share of the company's stock. This is the price which you can buy or sell one share of the company's stock on the open market. Earnings, on the other hand, represents the earnings per share, or EPS for short, of the company's. EPS is calculated by dividing the company's net profit by the number of outstanding shares. It's a measure of how much profit each share of the company has generated. Now that we know the components, let's look at how to calculate the PE ratio. The formula for the PE ratio is quite simple. PE ratio equals price per share divided by earnings per share. For example, if a company has a current stock price of $50 and an EPS of $5, the PE ratio would be 50 divided by 5 equals 10. Next, let's interpret what the PE ratio tells us. A high PE ratio is like miners feverishly digging for fool's gold in the hopes of striking it rich. Just as the gleam of fool's gold can deceive miners into overestimating its value, a high PE ratio can deceive investors into overvaluing stock. It's a feverish pursuit fueled by the illusions of endless wealth, but in reality, it often leads to disappointment and financial ruin when the glitter fades, revealing nothing but worthless rock. A low PE ratio is like a deserted playground, where swings creak in the wind and the merry-go-round rusts from neglect. Just as the absence of children suggests a lack of vitality, a low PE ratio suggests a company devoid of growth prospects. It's a haunting reminder of dashed dreams and abandoned potential, where investors tread cautiously, wary of investing in a future that seems bleak and uncertain. There are different types of PE ratios to consider as well. Let's explore the types of PE ratios. The trailing PE is based on the earnings of the past 12 months. It uses historical data and reflects the company's past performance. The forward PE, on the other hand, is based on estimated earnings for the next 12 months. It uses future projections and can provide insight into anticipated growth. How can we use the PE ratio effectively? The PE ratio is often compared within the same industry to gauge relative value. As in different industries, the PE ratio is often compared within the same industry to gauge relative value, as different industries have different average PE ratios. This is known as industry comparison. Comparing a company's PE ratio to the broader market or specific indices provides a sense of its valuation in a broader context, known as market comparison. Investors use PE ratios differently based on their strategy. Growth investors might prefer high PE ratios expecting future growth, while value investors might look for low PE ratios as potential undervalued investments. However, the PE ratio has its limitations. Companies with highly volatile earnings can have fluctuating PE ratios, making it difficult to interpret. This is due to earnings volatility. Like real estate rights, it's very hard to gauge their PE ratios. Variations in accounting practices can affect reporting earnings, thereby impacting the PE ratio known as accounting differences. Non-earning companies are like echoes in the void, their existence acknowledged, but their substance elusive. Just as the void swallows sound without a trace, negative earnings swallow hope for meaningful valuation metrics. They're the forgotten whispers of failed ambitions and shattered dreams, haunting the financial landscape with their silent presence, unable to find resonance in the world of profits and losses. In conclusion, the PE ratio is a useful tool for investors to assess the relative valuation of a stock. However, it should be used in conjunction with other financial metrics and qualitative factors to make informed investment decisions.